you've traded up green the whole way in the first part of the month, and now we're already giving up some of that right now, and you've just had a PPI number, as we're just discussing this because it's just happened, and you're watching the fizzle back on that candle. So I can't tell you where it closed. I haven't got a glass ball, but what I can certainly say is that for one or other reason on this monthly time frame, there is a lot of selling in this box zone here, and you shouldn't ignore that at all. You shouldn't ignore that. So I'm concerned, and that is attempts to go higher that are reversed back down. That doesn't mean eventually you can't win in the end, but you might end up having a hammer first, which is the opposite candle at some point. That's been our view. So you get a
3,500. Is that the level? 3,500?
That's 3,500's up top there. That's on the dot there. Yeah.
Gold didn't crash. It didn't soar either. It just stopped moving with conviction, and that's driving traders crazy. FrancisHunt, known as the market sniper, sees this not as a correction, but as a pause. After a powerful rally, markets often drift sideways before the next push. Gold is doing exactly that. The recent PPI data and the pressure of higher rates gave it a nudge lower, but nothing close to a breakdown. Look closely, and you'll see the pattern Hunt points out. The metal keeps circling the exact numbers: $3,288, $3,289, $3,303, $3,290. That kind of clustering tells him both bulls and bears are locked in a standoff. Sellers won't let it break higher, but buyers refuse to let it fall apart. It's classic consolidation. The one real outlier was the spike to $3,500. Hunt calls it a blow-off. Trump's tariff theatrics acted like jet fuel on an already bullish setup, sending prices vertical. But just as quickly, they cooled. That doesn't erase the long-term story. It just shows the move wasn't sustainable. A climb from $2,000 to $3,500 in record time demands a breather. Where Hunt pushes hardest is against the dream of revaluation, the idea that gold will suddenly reset overnight, multiplying in price and handing out instant fortunes. He calls that moon boy thinking. A shock like that would shatter the banking system and the massive derivatives tied to gold. His advice is simple: see gold as a long game. Accumulate gradually, stay patient through the churn, and let price discovery unfold over time. The pause we're in now isn't the end of the story. It's the build-up for what comes next. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. Thanks for watching.
When we spoke of gold, we said, yes, you are going to just not go up. It's progress decay. We're not calling for something like a 10 or 15% sell-off. We're just saying you're not going to be strong in any immediate moment straight away. You've got a couple of weeks of churn. And look at this right here. Let me take some of the drawings off. You've just had this PPI number come in and you're trading off down. So, I think you're going to probably remain in range here with possibly a bit more scope for a bit of downside and churn. We've said ourselves that if you break violently above the 3,440, sorry, it's that line there, we would get back in on the long side. So and we gave our reasons, we gave technical reasons. We don't have the time to go too deep in that, but we showed also that apart from the 293K run, that most of the surge was kind of a little bit mini blow-off brought to you by the tariff tantrum. So once you'd run the 3,000 over here, you were having a natural pullback, and you got an extension because of geopolitical events. And since then, you've had that blow-off surge. It's kind of you've run an extra 100 meters when you were doing a 1,600 event. So now there's a bit of a pause and a bit of a rest. And we've got this structure. And you've just had that PPI number. Higher rates are not good for gold, neither Bitcoin, by the way. And you're looking a little bit flat and you could sell off. So we just think it's not ready to break out. Once this rejection occurred and it went down like that, we looked to the monthly chart as we have done, and we showed that and just highlight that every time you're getting at 3.4, you are closing. That was the 3.5 high. You closed at 3.288. That there is 3.289. That is 3.303. And that is 3.290. So I'll just say that again. By the time you finished each month, but for one minor mini outlier, which was $15 away from the lowest one, you'd close to within $1 each time.
Wow.
So say it again: 3288, 3289. Then not much more than $14 away, 3303. And then closing back down here, 3290. So you got three closes that were $1 apart. So there we go. Just look at this number. Let's make sure everyone's with us and watching the right number there. So what's the number? The close in April, 3288. You see it? The close in May, 3289. The close in June, 3303, which is $15 away from the lowest number. And then the close in July, 3290. So 88, 89, 90, and 03. Well, what I can tell you is there's certainly rejection that was coming in. Then you had that rickshaw boy, and 50% of it was the rejection there. Then you have this doji candle, and it's mainly rejected on the high side. Then you have this shooting star candle, which is known to be at localized highs, which is why we're saying for a longer period than most expect, 3.5, which it just hit and was absolutely stopped right down there. Remember, at 3.5, because it was a couple of cents through 3.5, you're closer to 4K than you are to 3. So they didn't like that. And that blow off that Trump's tariff tantrums caused was most unwelcome. So you've traded up green the whole way in the first part of the month, and now we're already giving up some of that right now. And you've just had a PPI number, as we're just discussing this because it's just happened, and you're watching the fizzle back on that candle. So I can't tell you where it closed. I haven't got a glass ball, but what I can certainly say is that for one or other reason, on this monthly time frame, there is a lot of selling in this box zone here, and you shouldn't ignore that at all. You shouldn't ignore that. So I'm concerned, and that is attempts to go higher that are reversed back down. That doesn't mean eventually you can't win in the end, but you might end up having a hammer first, which is the opposite candle at some point. That's been our view. That's 3,500's up top there. That's on the dot there, yeah. But you may get something like that at some point before trading back up and have a little test. I don't think it's the end of the world. It's just everyone who's expecting. It's amazing how the YouTube hype is an inverse rule sentiment indicator. I've never seen so many reval videos. Listen, if you had someone on who was talking about reval, that's no bad on you. If it's topical and has been spoken about, have it. But I'm kind of the anti-reval guys. They're not going to blow up the banks or the derivative markets by doing a 4 or 5x on the money just to open up overdraft that they'll end up consuming and then need to do again. They can't do it. The derivatives, it'll all be, unless they're ready to concede that, which I don't think they are. And remember, those banks have been doing the work for this cartel. You have to see it as a group of criminals in different departments. They're not going to, they're the shareholders of the Fed and the funders, and the banks are the funders of the political system. So no junior leader in the political system is going to bankrupt his boss. That's how I see it. So there's too much of this hopium. I want gold people to go back to being stoic, patient people. We're going to continue to get our rewards. This moon boyism is something I prefer to see just in crypto. I prefer it wasn't in crypto either, but the younger generation have their lessons to learn. But the smart old graybeards of precious metals stacking should get out of the notion of overnight sensations. We're not lottery ticket buyers here. We want to see this trade up through a price discovery mechanism and be unleashed. And you just had a major move from the 2000 level that took you right up to the 3, and then a blow-off surge to 3.5. And now you've got to rest a little bit. So don't expect too much. And so dollar, don't forget, on this interest rate story, might get a little bit of a bid. And in our YouTube video, we said, go have a look at gold Swiss franc, back again. So I'll show you this as well. You also met major targets on the Swiss franc. So we like to do 360-degree analysis. That's what we do. We try to see the valuations relative to many things. So that's the dollar for Swiss franc. You had a huge move. It made major targets. Let's show you those. There, a massive cluster of major targets. Targets are targets for a reason, because you're probably going to rest for a while. That's monthly. If we go back down to daily, we said on our YouTube channel that longer term, this red line breaks to the upside, but you're actually in a broadening structure that's tending to the downside, and you typically have 3 waves of selling. Flag, you can see it there. No real power to break out. Sell off, broadening structure. You can see it here. And now you've just had the bad news. I think you can get one more sell off. We typically have waves of 3 sells, 1 wave of sell, 2 waves of sell, 3 waves of sell. But then the next time you come, everyone will be bored and say, gold's not making me rich, fundamentals aren't coming. And then we'll be watching for a fractal here and a major breakout as a continuation pattern, even against the franc, which is slightly a better. By the way, the franc pays 0. The SMB's got a 0 rate. So all those arguments that get driven at gold that say gold doesn't pay interest, if you're in a semi-serious fiat, you don't get any interest. So gold is actually paying ahead of the Swiss franc for being a more serious asset and not paying a negative interest. And actually, if too much money leads America to get into francs, I think the next step will be the Swiss will actually charge foreign depositors in francs a negative rate to stop their currency from over appreciating, while gold will never do that.
The dollar has bounced after the PPI release, but if you zoom out, FrancisHunt says the story hasn't changed. The greenback still looks fragile. When that weakness resumes, he expects the Swiss franc to strengthen, the dollar to fade, and gold to break higher again. That doesn't mean piling in with leverage or trying to time a jackpot entry. Hunt's message is simple. Caution in the short term isn't the same as being bearish. Wait for dips. Add ounces quietly. The long game hasn't shifted. Where it gets interesting is when you line gold up against oil. Gold's been ripping higher. Oil, on the other hand, is dead weight. Even with wars in Ukraine and the Middle East, crude hasn't moved much. That signals a lot about the world economy. Consumers are strained, shipping is down, and demand just isn't there. That divergence isn't random. Hunt frames it as the long gold short oil trade, and it's already delivered. Gold massively outperformed while oil lagged. For him, the gap confirms that economies are cooling and capital is rotating towards safety rather than growth. Let's get back to the interview.
You're getting a little bit of a move up on the dollar after making our second interim on a downside break. So the technical setup is that, kind of goes like that. And we are expecting the 0.63 eventually to be run. But right now, you've had a little bit of a boost after running the second interim. And this is a month, but you were lower and you've traded a bit up now on that PPI news. I don't know how much further you go up, but maybe you do a mess around a little bit as FX markets can. And then when we get to this period, Danny, where we spill, that's going to be not only very good for the Swiss franc and bad for the dollar. Gold will be running again. So to everyone who thinks we're being bearish, gold will run again. It's just short term. I don't think you want to be leveraged long, and I wouldn't be chasing in with a massive lump sum. I'll try pick a relative low just to get more ounces. And the miners are catching up, by the way. I don't know if you want to hear about one miner that we covered today. Heckler. Yes, that's your monthly setup. It's currently trading 7.64, and we say it's going to run 85. It's actually a quarterly setup. Now I want to show you a setup within a setup. So let's drop to the monthly time that I was talking about and why we were kind of excited about this one. It had earnings report today. So, or was it yesterday? My apologies. I might be talking out of turn. So it's squeezing not only on that bigger setup that I showed you on the 3 months, it had a squeeze. We call that a primer, where you squeeze within a squeeze. So this is the monthly view of a much bigger view that's now off there. That's only our third high and our third low, which is tight. And if I take you into the daily, so we're dropping down time frames here, you had the earnings. There was a lovely little fractal and you were going into the earnings. And that was a gap up. If you waited for the earnings to buy, you ended up at best getting in there. You should have got in there. Beautiful little setup on that one. and I'll show you it. Currently at a target. I wouldn't chase in here. I think once you've just had a gap, you should let it wait. So let's get that one right and draw it for you. There we go. Again, an upside HVF there. You just smashed that target of 772, and you would have got in on the close at 611. 611 to 772. You made yourself 160 cents, $1.60 on a $6 share. That's a 20% move in a quick move, and you can see it pulling back now. And that might have something also to do with the PPI. People will say, well, we've got a bit of an event. This is an accumulate on the longer time frame, however, and this is one of the values of HVF. We let this pull back. We keep adding to the portfolio. Had you bought it here, you would have got in real cheap. Then you are in a break for 85, and you would have a stop super tight at about 603. So miners are starting to wake up, and that's definitely a good thing. Let's take you back up to that big setup, all the way back up, and there it is. Let's do it. Whoop, take that one off. That's it. 85 is our expectation for the stock up there. That's quite some way away, 84.75. So there's quite a few miners that are well set up for quite big moves. Don't forget, you're talking to the guy that said a year ago, long gold, short oil if you want a commodity neutral trade. And that is wrecked consumer, low oil prices. Don't forget, we've got a hot war in Israel, or genocide, however you want to frame it. You've got a Ukraine-Russia war. You've got all of this, and you've got oil barely moving. That's a wrecked consumer. And you've got a collapse in the debt market and financial repressional times. Gold absolutely running. So the gold oil trade that we've discussed a few times with you actually made its target. Another reason, thank you for finishing my sentences for me, by the way, because this is the other reason why we are saying gold might have a rest for a bit. Let's just show you that trade. There you go. Another cluster of targets. So we said quite some time ago, it was in first half of July when we broke here, that, hey, guys, gold is going to go from 28 barrels an ounce of gold to more than double that, and you did. You made from 28 to 58. That's well through the 56 mark and took out both our targets that we had for that. That's a big overperformance for gold and an underperformance of oil. And some will say, well, why did you need to short the oil? Why didn't you just be long gold? Gold went up. Well, oil at that date was $86. What's it now? Go have a look at oil. It's largely gone sideways. So many people thought, well, there was no alpha in the oil half of that. Here's where you are on oil. You're at July 24, you're up top here around 83. And today you're at 63. It's $20 better. So it reduced the volatility of your trade and made you delta neutral, which people don't understand the value of that if they're new to trading. But it's an incredible, powerful thing, because if inflation is a thing, all things should be going up. Actually, we traded in an inflationary environment, but the stagnation, did damage to oil in spite of the inflation, whilst the reserve asset part of gold not only saw the inflation act on it, but the fact that it is the primary asset that preserves value that everybody is short of, overperformance on gold and relative underperformance and nominal underperformance in an inflationary environment of oil. And that's why you got alpha on both legs of that trade. And, that's pretty cool, I think.
Momentum in gold's story remains defined not by spectacular breakouts or sudden crashes, but by the quiet resilience it shows in the face of shifting economic signals. Prices have surged, cooled, and consolidated, yet the underlying trend remains unyielding. The contrast between gold's strength and oil's lethargy is more than a trading setup. It's a reflection of global strain. Sideways phases may frustrate those seeking instant gains. Still, history favors disciplined hands that ride through the noise. The real narrative is about patience, measured accumulation, and recognizing that pauses are often the prelude to the next advance. As investors weigh this backdrop, the question is whether gold's current consolidation marks the foundation of a more powerful move ahead, or if the broader slowdown in global demand will extend the waiting game before its next decisive climb. So stay tuned. If you're into real data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.